All right, so in this section, we're going to talk about various different market cycles. As you can see by this chart, the best way to make money in the markets is to buy low and sell high. So generally speaking, a bull market starts out in accumulation. The price is generally really, really low, slightly boring, could even be low volume, stable. That's where the smart money comes in and starts accumulating coins. And then you'll have fundamental news events that'll trigger fear of missing out. Other traders and investors will start jumping in. Volume picks up, volatility picks up, and momentum picks up. And that's where you see the markup. Once the price has gone up a certain amount, then the media starts jumping in and they start reporting it. And that calls over more traders and investors. They see it going up and they say, oh, we better buy this. It's going to keep on going up. And then you get into over-exuberant bullishness where the trend gets exhausted. It becomes exaggerated and parabolic. And the smart money will start to take profit and sell, maybe even short on the breakdown. And the rest of the markets will buy high and then start to panic sell as it's crashing. So they kind of do the opposite of, instead of buying low and selling high, they buy high and then they panic sell as the market crashes over. And those who bag hold eventually hit a point of capitulation where they give up and let go. They can't take the pain anymore. And that's when you usually go into the next stage of accumulation. And so this market cycle happens on smaller time frames. It also happens on larger time frames. So you can have small bull cycles as well as large bull cycles and vice versa with bear cycles. So before we get into specific charts, let's look at how candlesticks work. So a candlestick chart is a way to visually represent the price between buyers and sellers. So when you have a green candle, it means that the price started here and it closed here. And the wicks will show you the high and the low. So it could start here and then maybe shoot down and shoot up and then close here, or any combination of that. And vice versa. If you have a red candle, it'll open here. There's a high, the low, and then the close. And when you put them all together, it kind of paints a story and a picture. And so let's look at some of the Bitcoin charts to see what kind of pictures we can see in the charts. All right, so looking at the charts, we can see there's accumulation. So those who were early adopters in Bitcoin who accumulated when the price was really low, not a lot of volatility. And then you can see the markup on the first major bull trend when this price hit about $253. And then it got exaggerated. See, the thing with the markets is they're kind of like an elastic band, right? The further back you stretch it, the more it snaps. It's kind of like physics, right? You have inertia, the market's flat and stable in accumulation. Then you have momentum. So it ramps up with momentum, but then you hit a point of counterforce, and that's distribution, or vice versa, if it's going on a downtrend. And when you have counterforce, you create momentum in the opposite direction, and that's called a reversal. So that's where you'll see the mark down. But because there's a lot of momentum on that reversal, it also hits counterforce, and that's where we call a bounce play, right? It'll bounce back up, and then eventually the range gets tighter and tighter until it consolidates and you have inertia again, right? Until the next major breakout. So then on the next breakout, you have the exact same thing. You have inertia and then you have momentum. In this case, it was really exaggerated momentum, and therefore the price swings were also very violent to the downside, right? So the definition of a bear trend is a series of lower highs. So if I were to take a trend line, I can draw a trend line here to measure this bear trend. And the general rule for measuring a trend is it has to have about 3 points of contact. Now, trend lines are fluid and dynamic, just like the market. So they will evolve, they will move. Nothing's written in stone. Trading is kind of a combination between a science and an art. And so the definition of a bull trend is a series of higher lows, right? So that's how you can tell bull versus bear, right? And you also have the front side of a trend versus the back side of a trend. So if we just zoom in here, we can see here there's the front side of the trend. Think of it almost like the seasons, right? So in the spring and summertime, you have a lot of green. So all the candles are predominantly green, just like here, front side, front side, front side. Same here, front side. And then you have the back side, right? The back side's when you get a predominance of red and it starts to go down, right? So it's bull versus bear, front side versus back side. So it's important to kind of just identify, which side of the trend you're in, right? To be able to ride the trend with momentum. And so you could also identify price ranges. So just remove all of these. Support and resistance. Oftentimes what will happen is you can draw lines to create support and resistance. So let's just take this range right here, smaller time frame. As we can see here, there's a tight range of support. So support is a price area where buyers step in and take control. So, we sold off a bunch and then buyers stepped in, it bounced, buyers stepped in, retested support, it bounced, came back up, retested support, it bounced, right? So multiple times of testing support where the buying strength is very solid at this level. And then you can have resistance where sellers step in, right? So as you can see, it bounces and it pulls back and it bounces and pulls back and so on and so forth. So sellers step in. And then you have a range within support and resistance, right? And you can do that on multiple different time frames. You could do that on this time frame right here. See, in 2015, this was the accumulation zone of the bull trend, right? So we had this downtrend, so it was marked down all the way down, right? And then we had accumulation, so sideways, kind of boring. And then finally, we broke out into the markup and had various different accumulation and distribution points along the way. And eventually, what'll end up happening is we'll hit a major distribution point and have another mark down and a bear trend, a longer bear trend. Now, you just want to make sure that you're on the right side of the market. So if you stick with the simple principle of buy low and sell high, then generally you'll be okay. But for a lot of people, that's difficult because of managing emotions and the psychological impact of that. So let's look at some various other examples of support and resistance. Right? You could also have support along a trend line. So, right here we had an immediate support along this trend line, multiple points of contact where buyers would step in along the trend line. And then we had multiple points of resistance. And the interesting thing is that when you break out of resistance, this is called a breakout, right? And when you break below support, this is called a breakdown, right? And it usually means that there's going to be more downward price action or more upwards price action, right? So in this case, we have a breakout, which created momentum moving on the way up, counterforce, momentum on the downside, counterforce, markup, more momentum on the upside, counterforce, so on and so forth. And then the range gets tighter and tighter and tighter into consolidation, inertia, right? Momentum, counterforce, momentum, counterforce, momentum, counterforce, momentum, counterforce, and then inertia. And you've got just smaller oscillations. And there's consolidation or inertia even in these smaller movements too. So if you get down to the smaller time frames, you can see that same type of market behavior, but just on much smaller time frames, right? So when you're trading, it's important to identify when you're in momentum. So when's a good time to ride the trend and go with everyone? When to be a contrarian and go against everyone with counterforce, and then you'll ride momentum on the opposite side, and then vice versa. And then when to stay out of the market when you have inertia consolidation, because the volatility price range really tightens up. So that's it for now for this market cycle section, and we'll see you in the next part. Cheers.